In this video, you will find out how I choose investment properties by data modeling. Let's get started. If you are interested in real estate, you probably have heard of the price to rent ratio, which is house purchase price divided by rent. Whether it is monthly or annual rent, it doesn't really matter, as long as you keep your formula consistent. The lower the ratio is, the better investment opportunity it indicates. In China, we use the other way around, rent to price. So the higher the better. It is essentially the same thing, just pick one. I used to use this rule to do a calculation in my mind when it comes to investment consideration. For example, house A selling price is $500K, with monthly rental estimation of $2,500. House B selling price is $400K, and rental estimation is also $2,500. Definitely go with house B, right? It works well if you are considering the same city, same neighborhood, meaning all costs hold the same. Costs include but not limited to property tax, insurance, maintenance fee, HOA, etc. However, if you haven't decided on an area to invest in, a lot of factors may weigh in. How do you make decisions then? Does the higher the rent to price ratio, the better rule still work? A quick answer is no. If you like my content, please make sure you subscribe and thumb up. That's the only way to keep me going. Now, let's dive into the model. And I will show you step-by-step calculation to draw our conclusion. I picked a few houses we and our friends have invested in. So these are mostly real data. Let's start with inputs. On the top, we have your income tax bracket. I use 46% here. Please notice this is not your effective tax rate because your rental income from the properties are incremental income. You need to pay this percentage of tax on any actual dollar you earn on top of your salary and other investment income. Next, down payment rate. Usually for investment properties, the lowest we can get is 25%. Besides, as concluded in my previous video, we should maximize LTV or minimize down payment. And the next one is the lowest loan interest rate you can get by shopping around. Next is loan years. I use 30 to start with as the most common one, as well as to maximize our cash flow. The next two inputs are a little bit interesting, and I don't think many people think about them. One is the annual rental inflation rate. We use this as an estimation to calculate our annualized rental income, not just the first year. Another one is annual property tax inflation. Especially in some other states, property tax estimation can be complicated. The county or city keeps increasing property tax every year, even if you keep holding onto the property. This gives us a ballpark estimate. You can check on Zillow or Redfin to see the history of the property tax and do an estimation on the house you are looking at. By now, you probably noticed that all the cells with yellowish color I use in my models are indicating inputs. So in this main table, the first input we have is how many years do you want to hold the property? Let's use 30 to start with. And of course, the purchase price or the price you are willing to pay. The next input is initial improvement plus closing cost. Initial improvement will fully depend on how good or bad the house condition is. If you buy a really bad condition house with a cheaper price and put a chunk of money to improve before renting it out, you need to input the data here to see if that makes sense. Usually that's your initial cost because you cannot get loans from the bank. Closing cost is usually 1%, as I mentioned in my previous video. And then the monthly rental income. You can get an estimation from Zillow or Rental Meter. The next one is vacancy rate estimation. This is an interesting one and a hard one. It has so many factors. For example, economy, whether it's booming or sinking, neighborhood. If it's not very good neighborhood, the tenants may delay payment or break lease more often than a good neighborhood, hence higher vacancy rate. 15% is what I use based on our experience so far. This includes the tough COVID period. You may need to adjust based on the neighborhood. Factors you should consider include but not limited to population and economic growth in the city, tenant profile in the location. For example, students versus young working professionals or families. You can do more research by searching top cities to invest in real estate on Google search. Home Union has a clear definition of the neighborhood of the house on their website. For example, A, B, C. A represent the best. Once you identify a few houses, you can get an estimation on first-year property tax, insurance, and HOA. As for maintenance annual fee, it again depends on the house condition. The next two inputs, property management fees and renewable fees or new tenant fees, totally depends on which company you go with, what charging model you choose, or whether you manage the property by yourself. Like the third row here, because it is a self-managed property, the fees are both zero. In this case, you can even get more tax relief if you manage properties by yourself. I will have another video to talk about using a simple data model to choose from different charging rates that our property management company provided to us. Now we have all the inputs. All the other columns in this spreadsheet are built-in formulas and will be automatically refreshed. Take interest as example. I wrote a function in JavaScript to get the interest paid by the end of the years we hold the property, and divided by the number of years to get annualized interest paid. Another example is annualized property tax. As mentioned earlier, because many states increase or decrease property tax every year, and in general, it's increased quite significantly without selling the house. I use this formula for now to calculate this. The JavaScript at home is down now. I will write a function to make this more accurate later before I share the model. I won't talk about the formulas one by one, given I will share the model later. Now let's look at the most important part. Start with taxable income. It is straightforward. Basically, it is the annual gross rent income minus all the costs. And that minus tax on the taxable income is your after-tax income. And of course, we need to add back the tax return on the self-management fee, if there is any. With this after-tax net income, we have our first key result, net ROI. Another important final result is cash flow and cash-on-cash. As the assumption made in my previous video, this needs to be at least above zero. As you can see here, with the 30 years of holding period, they are all above zero. The key conclusion I want to make in this model, however, is the comparison of ROI or cash-on-cash among the properties and contrast between ROI or cash-on-cash and rent to price ratio. As you can see, the first property has the highest rent to price ratio. If we had applied the simple rule I mentioned at the beginning of this video, we would have gone with this property, right? However, because those different properties are located in different cities and different neighborhoods, the costs are different. Therefore, from an ROI or cash-on-cash perspective, this is not the best choice. Actually, it's the second worst choice. The top choice is the one that has the second lowest rent to price ratio. By now, you might be curious, what does the ROI and cash-on-cash look like each year, given the calculation here is annualized? The chart below shows what it looks like with the current inputs. Now, let's play around. Let's change your income tax bracket to 35%. As you can see from the chart below, your ROI and cash-on-cash are much higher every year. But it doesn't change the conclusion of which property to choose. Now, let's say you don't want to hold a property for so long. You want to sell the house in 15 years for whatever reason. Other things held constant, your ROI and cash-on-cash remains the same. Of course, everything ends after the 15th year. However, your annualized ROI and cash-on-cash are much lower now. In some cases, you can barely get positive cash flow. In summary, taking into account all the factors that contribute towards ROI or cash-on-cash, this model can provide you a clear conclusion, which house to choose. I hope this is valuable to you.
All right, folks, that's all for today. Thanks for watching.